It's only natural that we probably could assume over time in most circumstances, our rate of return is going to be higher on the risk products,
Right.
right? But the reality is, because of those guarantees, if we leverage them, we can again come up with a better overall, more efficient retirement plan that produces more income. And who's in the business of risk management?
Insurance companies.
Insurance companies. And what main risk are they dealing with?
Your life.
Mortality.
Yeah,
Yes,
your
it's your
expectancy.
life.
Yep.
And so they have that ability scientifically to provide those benefits. And this is well ironed out.
Yep.
This is not a new game to them. They have the ability to offer those guarantees. And that's where we can utilize them to help us in our overall planning.
And this is something that we didn't have to actually talk about in our 7 hours together so
Yeah.
far, but we insure our homes, we insure our cars, we we do health insurance, and that's one of those things would be like, yeah, of course, some of the times we need to. It's like you're required, but even if you weren't required, any reasonable person would say, yeah, could I self-insure my home? Yes.
Yes.
Can you self-insure your car?
Mhm.
Yes. Can you self-insure your health insurance? Sure, even though it probably is illegal. But the reality is any person that is like looking at it from an efficiency standpoint, if I'm going to self-insure my home, now I'm going to have money tied up that won't be able to be used in any other place if I'm truly going to self-insure. And if I'm going to self-insure other areas, now I'm being less efficient. So if we get that, like I think majority of people understand that concept. But then why do we know we're going to die. We know that's going to happen. And yet we're like, oh, permanent life insurance is super expensive. Like, and we almost don't like factor in like, okay, if we know something's going to happen, we go to a company that helps us pool the risk. Like, wouldn't logic say like we should look into seeing if that would? I know I'm just verbally processing right now, but like, do you kind of understand what I'm trying to?
Well, let me
say?
build on that a little bit. These other types of insurance are all if insurance.
Yeah, this is a when insurance.
This is a when insurance, and what's so ironic is the one thing that we know is going to happen. It's just a matter of when. Why we fight back so much about putting that protection in place. And I think it gets back somewhat to selfishness. We know that we're not going to be the beneficiaries of the death benefit. However, I think we're going to give, in the recordings that we've done today, ample ammunition, so to speak, of how you're going to take advantage of that death benefit while you're still alive.
Yep, I love it.
Okay.
All right, let's go to point number 7.
All right. On this one, let me set the stage for this, and then we'll play a couple of snippets. By the way, these snippets are throughout the video, and if you watch it in its entirety, I would encourage you to also be watching for these. But basically what Brian and Bo are doing is they're positioning themselves to approach this product with no understanding of what it's about from a standpoint of infinite banking. They're approaching this product as though they're being very unbiased about it. They're neutral. And they make statements about, well, we could have done this, but we didn't. We want to give it the best picture possible. So that's all fine and dandy. But we're going to start to do is break that down. They are not being unbiased in their evaluation. And I want people to understand that and be able to see that as well. You can even pick it up in their voice inflection. And if we learn to recognize these things, I think it also helps us as consumers. So with that in mind, let's play the video.
The whole point of infinite banking, of banking on yourself, is that I can use myself as a bank instead of having to use the bank. Well, if you do that, all the numbers get smaller. They go down, they get lower. So if you actually use this strategy the way that it was designed to be used, it actually looks worse.
All right, so let's hit a couple of things where they're missing the boat and they're not treating it unbiased. First of all, they talk about borrowing against the contract. Now, if you pay interest on the loan all the time, you don't affect its performance at all. So that would be one point. is you can't just say, well, we're treating it and giving it the most favorable light. So borrowing has to do with it. And we'll get into others as we dig into the video. But I want you to understand what it boils back down to is they really don't understand the whole premise behind infinite banking.